Hello, my name is Kyle Siren, Customer Risk Manager with Ardent Mills Solutions. Wheat futures have been extremely volatile. Chicago futures recently traded over $6 a bushel for the first time since 2015. Soybean futures are threatening to trade $11 a bushel. Corn futures, which were just trading $3.10 a bushel just a few months ago, are now just shy of $4 a bushel. To paraphrase the great football coach Vince Lombardi, what the heck is going on around here? We're going to attempt to answer Vince's question in this edition of the Inside Scoop. Welcome to the October edition of the Inside Scoop. The USDA made some production changes to wheat on the September 30th Small Grains Production Summary Report, and these changes, along with changes from the September 30th Grain Stocks Report, were updated on this month's supply-demand tables. We will start with hard red winter wheat. The USDA lowered its production 36 million bushels to 659 million bushels, which is the smallest since a severe drought hurt the crop way back in 2002. Combine this with some changes to the previous marketing year's demand and stocks, the new carryout this marketing year is 334 million bushels, which is the smallest since the 2014-2015 marketing year. This year's stocks-to-use ratio for hard red winter wheat is 40%, which, as you can see here, is the smallest since the 2013-2014 marketing year. What does this mean besides we have less hard red winter wheat than we've had the past few years? Let's take a closer look at these two marketing years when the U.S. had a similar carryout and a similar stocks-to-use ratio. This chart is nearby Kansas City wheat futures. We have circled roughly when the 2013-2014 marketing year occurred in white, which was June 1st, 2013 to May 31st, 2014. We also circled roughly when the 2014-2015 marketing year occurred in orange. As you can see, during the 2013 to 2014 marketing year, Kansas City futures averaged over $7 a bushel. During the 2014-2015 marketing year, Kansas City futures averaged just shy of $6 a bushel. It should be noted the dollar was much weaker in these times, as we have noted. Russia was also just emerging as the dominant wheat exporter. The world was still recovering from the 2012 crop disasters in U.S. corn, Russian wheat, and Brazilian beans in the 2013-2014 marketing year. But this does make us think and illustrate that Kansas City wheat futures are quite different in a quite different environment than they've been for the past few years when we've had a stocks-to-use ratio over 70%. The path forward is not clear. But what does look rather clear, it's going to be hard for Kansas City wheat futures to return to $4 to $4.50 anytime in the recent future. Hard red spring wheat and soft red winter wheat did not see significant changes to their carryouts. Spring wheat carryout this marketing year is still historically large, and the soft red winter wheat carryout is still rather tight. Next marketing year, these two classes of wheat could have a very different outlook based on how acres might get allocated to these classes of wheat. Spring wheat demand also has to pay attention to its price relationship to hard red winter wheat. Last week, Minneapolis futures briefly traded under Kansas City wheat futures. Think about this. The higher protein wheat was trading below the lower protein wheat. As you can see, this has happened before, but it has been 5 years since it last happened. Back then, it was a similar situation, a big hard red spring wheat carryout and a tight hard red winter wheat carryout. The market is trying to tell users of hard red winter wheat to use spring wheat instead. It is not easy to do this, and it's not as easy as simply flipping on a light switch. This takes time. But for spring wheat users, Minneapolis wheat futures have not rallied anywhere near as much as Kansas City wheat futures. If Kansas City wheat futures continue to rally, Minneapolis futures will possibly keep up more than it has the past month and a half. Corn and soybean combined acres were cut by almost 2 million acres. This and a stocks adjustment from the September 30th stocks report, and that the U.S. corn carryout was lowered by 336 million bushels to 2.167 billion bushels. This creates a stocks-to-use ratio of just under 15%. What is rather remarkable is just a few months ago this was well over 20%. But with a loss in production and increased Chinese interest in U.S. corn, this carryout has tightened. It is likely even tighter than this, as the U.S. has sold 10 million tons of corn to China this marketing year, but the USDA's forecast for Chinese imports is a head-scratching 7 million tons. Soybeans saw its carryout tighten 170 million bushels to 290 million bushels. This is a stocks-to-use ratio of a little under 6%. As you can see, after a few years of large U.S. soybean stocks, the U.S. is forecasted to be tight on soybeans this marketing year. It is possible that Chinese demand for soybeans is greater than what the USDA is projecting, which could tighten this even further. Keep an eye on soybeans, as it feels likely soybeans will be trying to steal acres away from wheat and corn in 2021. If we are honest, we could keep talking about weather in Russia that is hurting their ability to plant their winter wheat, weather in Argentina that is hurting their wheat crop, and a lot of other subjects that are affecting prices. The bottom line is this: demand for agricultural goods is increasing, and the supply, through less acres and smaller than expected yields, is declining. Grains in the U.S. have been oversupplied versus demand, and this has led to low prices. This is changing. With that, prices are changing and volatility is on the rise. If you would like to talk more in depth about this, please feel free to contact us. We are here to help you understand what the risk is for you and your business. Until then, thank you for watching and have a great day.